Welcome back. So another tough session for markets today, not necessarily shaking off any anxiety over the weekend. Instead, the Dow's off more than 100 points, though we are up the session lows, especially for the NASDAQ, about half them at this point.
What'd you say? It was down 72 at one point?
Yeah.
So they've cut it in half right now. Hey, Seema Modi, give us a roundup of the movers today.
Absolutely, Bill. We're seeing selling across the board here. Let's begin with Pfizer falling despite reporting some positive trial data for its breast cancer drug. Investors were hoping for better results from the phase 2 study. Now, a tough debut for Land's End, the stock taking a hit on its first day of trade after being spun off by Sears. Sears not faring much better. World Wrestling Entertainment plummeted despite saying it's on track to getting 1 million subscribers for its network by the end of the year. Barron saying that might not be enough to counteract the drop in pay-per-view event revenue. Intel shares, though, moving higher after Pacific Crest upgraded the chip maker to outperform from sector perform, noting improving corporate PC demand. And we'll end on Procter & Gamble, gaining ground after increasing its quarterly dividend 7% to 64 cents a share. Bill and Kelly.
All right, Seema, thanks very much. So the bright side to a couple of sessions like this, that some stocks are going to be unfairly punished by the broader falling market.
Yeah, call them sort of the babies in the bathwater stocks. The key is knowing how to spot them, of course. Our next two guests say they feel they've identified some names that fit that category. And joining us, David Seaberg, head of sales and trading at Cowen & Company, and Craig Hodges, co-portfolio manager of the Hodges Small Cap Fund. Good to see you both. David, does that suggest that there is an irrational sell-off going on right now if they're selling everything?
Yeah, I mean, they're selling things broad-based right now. I mean, again, it's it's an orderly sell-off, but there's a risk-off mentality going on, and it seems to be more broad-based today. But when you look at different sectors, you have to break it down in an intelligent way, especially if you're trading them, right? So you look at tech. Tech is, you know, a general risk off. You're seeing core institutional holders sell these names, right, and go into more value tech names. Biotech, large cap biotech, extremely different. We're not seeing people take money, the core holders take money off the table. Maybe trimming here and there, but we're not seeing them bolt out of those names. We're not seeing broad-based selling. I think it's a very different way to look at the two sectors. And again, my two picks, I'm going to give them to you. Gilead and Biogen. I think these should be bought here, and I think they should be bought aggressively.
Gilead, the one that started this whole thing when Henry Waxman in Congress questioned their pricing of a drug, right?
Yeah, absolutely. I mean, the stock's come back. I mean, we've got, I think it's, stock came in from what, roughly, I don't know, it's sub 70 now, or right around 71 bucks a share from 85. I think the stock's going higher. We've got a $95 target on this stock. And I'll tell you, this Hep C drug they have is a very, 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 it eradicates Hep C. Yeah. Pricing shouldn't be an issue here.
In the meantime, sorry, go ahead.
No, Craig, I just said pricing shouldn't be an issue, Kelly.
Okay, sorry. Craig, what is interesting to me about one of your picks here is almost a port in the storm is it has the ticker HERO. I'm assuming that's just a coincidence.
Yeah, Hercules Offshore. What we see is that we need a correction. We need a, it's been, I guess, 2.5 years since we've had a 10% correction. I thought that was a long time, but I noticed there was no 10% corrections between 90 and 97, and there wasn't one between 03 and early 08. So these things can go on forever, but it appears the market's running out of buyers here. So a good correction, I think, would bring in a lot more buyers. There's parts of the market are very expensive, but there's a big majority of the market that's not. And
talk to us about a couple of the places you see value.
Sure. You mentioned Hercules Offshore. Stock's pretty close to its 52-week low. They're a jack-up rig company in the Gulf, mostly in the Gulf. I mean, the deepwater rates are soft, but the jack-up market is pretty good. The executives there have been insider buying. Stock's around 4.5. They see the outlook for the Gulf the strongest they've seen in over 30 years.
Yeah, and it's down 36% in the past year. So I guess if you liked it before, you love it now. Is that the idea?
Yeah, it's one, and they should earn 60 cents this year. So the stock is extremely cheap from that standpoint. We also think you ought to be, the strongest stocks that were in the market before this sell-off, kind of focus on those. Stay away from the high multiple stocks. We've been a proponent of American Airlines, or before that, U.S. Airlines, for a couple years. We think we could see $7 earnings out a couple years. So the stock at 35 is about 5 times earnings. We think that's a good growth vehicle.
And David, just to zoom back out for a moment, you had mentioned a couple weeks ago the fact that this market wasn't very hedged. Do you think that has something to do with the aggressive selling that we've seen? In other words, that people, especially if you look at the hedge fund returns the first quarter, they don't look that great. There's some tech funds really hit hard in March. So can you, what does that tell us? What is the message there?
Well, I mean, Kelly, the tech funds, I mean, they were hit hard. I mean, a lot of guys, they were short the growth name, short the value names to buy the fund, the growth names, and that trade reversed on them. So they got crushed. They got it from both sides. But look, I think that, no, I don't think people are really hedged right now. I think a lot of the selling we've seen has been, you know, let's say managers taking a percentage of their weighting in certain indexes down a little bit, you know, specifically in biotech. ETFs have been a big culprit of this, and I don't hear a lot of people really talking about that, but ETFs have been a major culprit in the pullback we've seen in a lot of these different sectors. Because you'll have, you know, people that I call renters, right, that own the IBBs or own let's say the large cap biotech space or own the biotech index. They're getting exposure, right? They're getting exposure to the space, but they're not core holders of the name like the institutional holders that we have. The institutional holders aren't blowing out of it. It's the renters. It's the people that have just pure exposure through ETFs that have taken risk off a little bit here or taken profits maybe in the sector. So it's a very different way to look at it. And that's why I'm telling you, I think biotech in general, right here, these two names I cited, I think are very good long-term bets.
Okay. Well, and one of them, we saw Gilead is higher today on a day like today. Good to see you both.
Yeah, I mean, relatively outperforming.
For savvy traders and investors, when we get a sell-off like this, your shopping list grows. That's how that works. Thank you both for your thoughts today. Appreciate it.
Thanks, guys.
Pleasure.
And we are coming back here. The Dow was down 160 points, now a decline of 108, and really